Welcome back to Audit Decoded. Today, we're diving into IT application controls, or ITACs, essential for every auditor and compliance professional. Think of ITACs as the digital guardians of your business transactions, ensuring data processed by applications is complete, accurate, and valid. These controls are built directly into the software your company uses daily, governing how transactions are initiated, recorded, processed, and reported. In today's business world, nearly every significant transaction flows through complex software like SAP or Oracle. Without strong ITACs, data is vulnerable to errors, fraud, and unreliable reporting. ITACs are the first line of defense, silently ensuring the integrity of your company's most critical financial and operational data. Imagine your business as a high-speed train. IT general controls are the tracks and signals, while ITACs are the locks and safety checks inside each train car. Both are needed for a safe journey, but they serve different complementary purposes. For auditors, mastering ITACs is non-negotiable. They provide direct evidence that financial data is reliable. When auditing financial statements, you need assurance that the numbers are correct. ITACs give you that assurance at the transaction level. In large environments like SAP and Oracle, where thousands of transactions happen every minute, manual checking is impossible. We rely on automated controls. Understanding ITACs is key to performing efficient, effective audits in today's technology-driven landscape. Let's break down how ITACs work and why they matter for your audit strategy. Many new auditors confuse IT application controls, ITACs, with IT general controls, ITGCs. Let's clarify. ITGCs are the foundation. They secure the entire IT environment, covering access controls, change management, and IT operations. They create a stable, secure setting for applications to run. ITACs, in contrast, operate within applications, tied directly to business processes and transactions. If ITGCs secure the building, ITACs secure each room. For example, ITGCs control who can access the Oracle server. ITACs control whether a user can approve a purchase order above their limit. The relationship is hierarchical. Strong ITGCs are a prerequisite for relying on ITACs. If ITGCs are weak, ITACs can't be trusted. An unauthorized change could render an application control ineffective. Auditors must first test ITGCs before relying on ITACs. Think of baking. ITGCs are your kitchen's conditions. ITACs are the steps in your recipe. In audit, trust the IT environment before trusting the transactions within it. This distinction is fundamental for effective risk assessment and audit planning. Let's break ITACs into 5 core categories or pillars with real SAP and Oracle examples. First, input controls. These ensure data entered is accurate, complete, and authorized. In SAP, mandatory fields for new vendors prevent incomplete records. In Oracle, drop-down lists for journal categories ensure only valid entries. Second, processing controls. These ensure data is processed correctly. SAP's three-way match and procure-to-pay automatically compares invoices, purchase orders, and goods receipts, blocking mismatches. Oracle automates depreciation calculations for fixed assets, ensuring consistency. Third, output controls. These protect the results generated by applications. SAP restricts access to sensitive reports like payroll, while Oracle reconciles aged debtor reports with the general ledger, flagging discrepancies. Fourth, interface controls. Data often moves between systems. Controls ensure transfers are complete and accurate. For example, when sales orders move from a web app to SAP, control totals are reconciled. In Oracle, expense data from Concur is validated to prevent invalid entries. Fifth, master data controls. These safeguard foundational data like customers and vendors. SAP uses dual control for changes to vendor bank details. One user requests, another approves. Oracle prevents setting customer credit limits above thresholds without approval. Each pillar addresses a unique risk point in business processes. Input controls catch errors at entry. Processing controls ensure business rules are followed. Output controls protect sensitive results. Interface controls maintain data integrity across systems. And master data controls prevent foundational errors. In practice, these controls work together to ensure transactions are accurate, authorized, and secure. For example, a purchase order in SAP passes through input controls, processing controls, and output controls. In Oracle, a sales order is validated by input controls, processing controls, and output controls. The strength of your ITAC framework depends on how well these pillars are implemented and integrated. Weakness in any pillar can compromise the integrity of your financial data. Auditors must understand and test controls across all 5 pillars to ensure comprehensive coverage. In summary, ITACs are not just technical settings, they are embedded in every critical business process. Effective ITACs reduce risk, increase efficiency, and provide the assurance auditors and management need. As systems evolve, so must your understanding and testing of these controls. Mastering these pillars is essential for modern audit and compliance work. Let's see how these controls map to real business cycles. Now, let's see how the 5 ITAC pillars work together in real business cycles. Procure to pay P2P and order to cash O2C. In P2P, master data controls govern vendor creation, input controls enforce selection from approved lists, and processing controls check authorization limits. The three-way match ensures only valid invoices are paid, while output controls restrict payment report access. In O2C, customer master data controls automate credit checks, input controls prevent orders for customers over their limit, and processing controls ensure correct pricing. Interface controls reconcile shipping and billing data, and output controls automate invoice delivery. Each control addresses specific risks: overpayment, fraud, bad debt, or revenue errors. Mapping ITACs to business cycles ensures risks are covered at every step. This integrated approach is key to effective risk management and audit assurance. The Sarbanes-Oxley Act, SOX, made internal controls over financial reporting a legal requirement. ITACs are central to this, as most financial transactions flow through ERP systems. They provide direct evidence for financial statement assertions, completeness, accuracy, validity, and cutoff. For example, an automated control preventing duplicate invoices supports validity. A system-enforced pricing control ensures revenue accuracy. Testing these controls gives auditors assurance over billions in transactions, far more efficiently than manual checks. The three-way match in P2P ensures liabilities are only recorded when goods are received, supporting completeness. For SOX, documenting and testing ITACs isn't just best practice, it's required. Robust ITACs are the backbone of reliable financial reporting. Testing ITACs is systematic and evidence-based. Auditors start by understanding and documenting the control, interviewing process owners, reviewing documentation, and observing the control in action. Next, they assess design effectiveness. Will the control prevent or detect material misstatements? For automated controls, this means inspecting system configurations, like tolerance limits for three-way match. Then, auditors test operating effectiveness, often with a test of one, demonstrating the control works as intended. Evidence includes screenshots of settings, error messages, or exception reports, all properly documented. Strong ITCs are assumed for automated controls to be relied upon. Meticulous documentation is essential for SOX compliance and audit reliability. Companies often struggle with ITAC design and implementation. Common pitfalls include poorly designed controls like approval limits that can be bypassed by splitting orders. Over-reliance on manual controls when automation is possible increases error risk and audit difficulty. Segregation of duties conflicts can render ITACs useless if one user can create vendors and process payments. Fraud risk skyrockets. Many organizations fail to update controls as business changes, leading to outdated safeguards. Set it and forget it is a recipe for control failure. Regular review and improvement are essential to keep ITACs effective. Without this, even the best designed controls will decay over time. Building a strong ITAC framework requires embedding controls into business processes from the start. Maximize automation. Let your ERP system handle routine checks, freeing staff for higher value work. The shift to cloud-based ERPs changes how controls are managed. Focus on configuration and review SOC reports from providers. Emerging tech like robotic process automation, RPA, and AI enable continuous monitoring and predictive risk detection. AI can flag unusual patterns before they become issues, moving from detective to predictive controls. The future of ITACs is automated, intelligent, and continuous. Staying ahead of these trends is essential for every audit and compliance professional.